Ladies and gentlemen, traders and investors, a very warm welcome to our channel Polo Vega. On today's video presentation, we shall talk about different kinds of options as a continuation from what we've seen on our earlier videos. The combinations of these options shall still remain two-legged, but this time we're going to be talking about simple and pure combination of options with no mix of calls and puts. It'll be either a combination of calls or a combination of puts, and the idea of talking about these simple combinations of call options or put options is to have a definitive risk and a capped reward. These strategies can be very profitable in markets where the implied volatility is not very high or it's neutral to moderate. But before we go on to implement these strategies, the trader or the investor must have a very clear and a good standing or understanding of time decay, selection of strike prices, and the effect of change in volatility with changing market conditions. Before we start talking about these different kinds of combination of options, we shall touch upon the events from last week where we saw that there has been a revision of market expectations and the market has kind of baked in a bit of the optimism from the deal that Iran and the US could reach anytime soon. They saw a bit of jump in the gold market, which touched a low of about 4380, and then it jumped back to the 4590 area. The indexes, both Nasdaq as well as S&P 500, have again touched an all-time high, and oil has had a very good dip, more so on Friday, to touch its lowest low in the last 1 month. We shall talk about these charts in detail before we go on to the options. Disclaimer/disclosure. The contents of the presentation are for information purposes only. The material has been obtained or derived from sources believed to be accurate, but we do not guarantee its accuracy. The presentation is the 44th of a series of interactive videos aimed at educating our viewers, and we'd like to warn all our viewers of the risk associated with the business of trading and investment. Securities investment and trading is a highly risky business, and there exists a possibility of partial or total loss of investment. The ideas and opinions on our video are solely based on our analysis of the market, and we do not advise, recommend, guide anyone to take any trades based on the contents of this video. We do not take any responsibility for losses, partial or total, arising of trades based on the contents of this video. The chart on our screen is that of decay, and we're looking at the daily chart. Decay has been in a sideways trend since April last year and is continuing to do so. However, it's been struggling to find any direction during the past 2 weeks and has been printing alternate red as well as green candles, but most of them being dojis with no direction at all. Therefore, one needs to stay away from the decay and try to concentrate on other indexes and assets which have got a bit of mojo as compared to the decay. The chart that we see on our screen is that of NQ, which is the ETF based on Nasdaq, and we're looking at the daily chart. Nasdaq has been in an uptrend since the announcement of the ceasefire between US and Iran, and it has continued to print very bullish candles during the last 2 weeks. One can say that the index has already baked in the optimism from the deal that is going to be sealed between Iran and the US in the next few days. but it's also pricing in the profits the one can have from the investments in AI by different companies. Since the index in is a nice established uptrend and has been printing higher lows after higher lows on the daily chart, we shall need to find an entry point on a lower time frame, which could be the 60-minute or anything below that particular area, whereas we need to see a nice dip below the current level into a demand zone which is between 30061 and 29929 on the hourly time chart. Or if we are trying to play very safe, then we can look at entering at 29782.76, which is the previous high from the week earlier. If at all this particular index tries to revisit this area, then this could be an opportunity to get into this uptrend and cash on it, as long it keeps printing new higher lows after higher lows. The chart on our screen is the of ES, which is the S&P 500 based ETF, and we're looking at the daily chart. S&P, similar to Nasdaq as well, has printed a new high. It touched 7611 on Friday and closed at 7595.75. It's got a bit of bullishness, but it's not printed any explosive candles as we've done or we've seen on the Nasdaq. It's been mostly dojis with a few green candles which cannot be called as bullish candles. So there is still indecisiveness on the S&P 500, and we need to be careful if we want to take a long on this particular index. If we wish to join the uptrend, then we look at the 60-minute chart, and we could try to join the uptrend anywhere below 7534 or even at 7522. But if it breaks below 7500, then it could be opening the way for a new bearishness in the index. The chart on our screen is the of Nifty, which is NSE 100, the Indian index of IT stocks, or the online Indian index. Why we're visiting this particular chart today is because of its contrast or its divergence with Nasdaq from the US, where they have been printing highs after highs. The Nifty has not been able to take out its supply at all and has been printing lower highs and lower highs for the last 2 months since April. It touched its low on the 1st of April, which was at 22150, and then it managed to gather some strength to reach 24575 on the 21st of April, and then on it has been bearish. It has been moderately bearish to neutral, but it has printed two double tops in the area between 2400 and 24580, and one needs to be very careful when the index reaches this supply area, because it will find it very difficult to clear the supply that has been left behind. As of now, we can see that the price is visiting a demand zone or a pivot that was formed on the 13th of May, and one needs to wait and see if it manages to take a bounce of this area or it tries to break out, because if it breaks out, then the only support that it will find will be around 22140, and one could go into a short, or we could buy a put on the index if it manages to break in a convincing way. You need to see a strong drop out of this area for the continuation of the downtrend. But if it manages to find some support at 23400 and gets a bounce, then we need to take longs in a very cautious way. We can't allow the bearishness to stop us out on the long trade. So it's either we wait for a good rally out of this area, or we don't take any trade at all. The chart on our screen is that of XAU/USD, and we're looking at the daily chart. XAU/USD is the gold-based ETF, and it has been in a gradual downtrend. As we can see that it has made a new lower high week before last. That's around the 4700 area, or in between 4700 to 4750, and it tried to break below 4500 this week, but somehow it could not close below the 4500 line, although it touched 4380 on Thursday of this week. There is a bit of bearishness in gold, and it is struggling to find strength because of the strength in the US dollar attributed by the rise in energy prices. We still need to be very careful in going long on gold, as we cannot see a nice defined demand zone on the daily chart. There is a very big candle, supporting candle, we can say, between 4072 and 4500, which was printed somewhere in March 2026, but it's too big an area to try and get into a long. We need to see the establishment of a nice demand zone on the daily chart. Otherwise, one should wait for the current price to reach a supply area and then try to get into a short all the way down to the nearest support on the daily chart, which as of now could be anywhere between 4400 to 4387. The candles printed on the XAU USD daily chart are mostly dojis, and if we try to go to the lower time frames, we can see some areas where we can find a lot of support, and still as of now we have a nice demand area at about 4288, and the stop loss could go below 4366. So that's the low visited by XAU USD on Thursday, after it had a nice bounce on the back of the deal that could be struck between US and Iran. The chart on our screen is that of US oil, and we're looking at the daily chart. The US oil has visited the area between 87.69 and 85.72 on last Friday, and managed to close at 86.66, which is the lowest low in the last 1 month, and it is now positioned above a nice demand zone on the daily chart, which is between 85.45 and 83.11, we could try to get into a long in this area based on the strength and bullishness in all the energy assets around the world. Also, geopolitically, the situation is now very clear if the ceasefire is going to be extended or not, and based on the indecisiveness there, we could find some volatility induced in the energy assets when they open on Sunday night. Therefore, one needs to wait and position himself or herself to see if they can get into a long on this particular asset. Although there is this demand zone between 85 and 82.93 or 90, on the 4-hour chart there is a nice pivot that we can see between 82.22 and 79.0. This could provide a law of bounce on the energy asset if we manage to get into a long here, and if the US oil manages to get a drop into that zone. But otherwise, we could see an opportunity on the reversal of the energy asset on Monday on the 1-hour chart, and if we manage to see a nice rally out of this area on Monday, we should try and join the uptrend which has been ongoing for a very long time. The first of the option strategies that we're going to talk about is the ordinary bull call spread. This is a two-legged strategy, and here the trader or the investor who is going to implement the strategy is neutral to moderately bullish in his outlook. What he does is he buys an ATM or a 1 to 2 in the money call option at a low implied volatility so that he pays the minimum amount on the premium, and then he goes up to sell an OTM call option on the same underlying with the same expiry date. So this particular trade allows him to reduce his cost price for getting into the long bullish trade on the underlying. Now what we're going to see is that this particular option limits his or caps his profitability because of the reason that he is short on the OTM call option, and he shall not be able to make any profit above the strike price of the OTM call option if there is a rise in volatility and the market swings higher than expected. But at the same time, his risk is limited and defined to the net premium that is paid for getting into this trade. The relationship with regards to time decay is negative because of the long call option that he has entered into. But the effect of Vega, which is implied volatility, and gamma, which is the change in the premium with the changes in delta, are almost muted or invisible because of the OTM call that the trader sells. Overall, it's the net delta is positive for this particular trade, and the trader or the investor expects the market to remain moderately bullish, and he manages to gain the maximum profit when the underlying is at the higher strike price or anywhere above the higher strike price, which is the OTM call strike price, and his losses are limited to the net premium that he has paid, and his break-even point is the strike price of the ATM or the ITM long put plus the net premium. Thus, a moderately bullish investor or trader can make a small profit while getting into a trade in a neutral or moderately bullish market condition. The next strategy that we're going to talk about is the bear call spread strategy. This particular strategy is exactly the reverse of the bull call spread strategy, and here the trader is neutral to bearish on the market, and what he does, he sells an ATM or 1 to 2 ITM call option, and then he covers himself by purchasing an OTM call option at a higher strike price. His net profit from the trade is the difference between the two premiums, or the premium that he received from the short trade on the ITM less the premium that he pays for the OTM call option, and he starts losing money at the time the underlying starts going above the ITM strike price, and he breaks even at the net premium plus the ITM strike price. It is a net credit strategy for the trader since he is a receiver of premium, and he stands to lose the maximum when the underlying exceeds the OTM strike price or is at the OTM strike price. So his loss is equal to the difference of the two strike prices less the net premium that he has received. This could be a replacement for a covered call where the trader is long the underlying stock and then he decides to sell an OTM or an ATM call option to make a small profit while he is in possession of the stock. This could be a discounted strategy where he doesn't have to have the capital required to go long on the underlying stock, and he makes his profit by selling the ATM or the 1 or 2 ITM call option, and his cover is then the OTM call option that he purchases at a higher strike price. Here the net delta is negative and the time decay is in favor of the trader, and once again gamma as well as vega, their effects are muted, but if the implied volatility gets very high, then the trader stands to lose on this particular trade. The next strategy that we're going to talk about is the bear put spread strategy, and we are going to speak about the bear put strategy prior speaking about the bull put strategy, purely because of the relationship that it has with the bull call strategy. Similar to the bull call strategy where the trader is neutral to slightly bullish, here the trader is neutral to slightly bearish, and he gets into a long ITM or ATM put trade, and then he sells an OTM put option at a lower strike price on the same underlying with the same expiry date. The difference between the two strategies is here the trader is buying an ATM, ITM put and selling an OTM put, whereas in the bull call strategy the trader buys an ATM or 1 to 2 ITM call and then sells an OTM call. This also is a net debit strategy similar to the bull call strategy, and here the risk or the loss is limited to the net premium paid by the trader. But he starts gaining money as soon as the underlying starts going below the ITM or the ATM strike price, and he breaks even when the underlying is at the strike price of the ITM less the net premium received, and he then starts making a profit until the underlying reaches the lower strike price of the OTM, beyond which he doesn't make money because of the reason that he gets assigned on the put option that he has sold to limit or reduce his cost of getting into the trade. Thus, it is got a definitive risk, which is the net premium paid, but at the same time his reward is capped by the strike price of the OTM, and his max profit is the difference between the strike prices less the premium paid by him. It is a good strategy, and the trader gains from a slight increase in implied volatility, but if a sudden swing or a sudden dip occurs, he doesn't gain from the increase in volatility because of the OTM option getting assigned at the strike price. So it's a limited risk versus a limited reward strategy, which works best in neutral to slightly bearish markets. The last of the strategies that we're going to talk about in today's presentation is the bull put strategy. In the bull put strategy, we sell an ATM or a 1 or 2 ITM put, and then we buy an OTM put at a lower strike price. Here, the profit is limited to the net premium received, but the loss could have been indefinite had we not purchased the OTM put at a lower strike price. Therefore, we stand to gain the maximum profit if the underlying stays above the ATM or the ITM strike price, and we start losing money when the underlying starts dropping below the ATM or the ITM strike price, and we break even at the ATM or the ITM strike price less the net premium received, and then on we start losing till the time the underlying reaches the OTM strike price, where we manage to cut our losses and the complete loss is equal to the difference between the strike prices less the premium that we have received. It is a neutral to slightly or moderately bullish strategy, and we expect the underlying to stay above the strike price of the ATM or the ITM put that we have sold. But if the implied volatility goes up, or for any reason if the market dips below the ITM or the ATM, then we start losing money, and then we cap our losses at the OTM strike price. Traders, investors, we now come to the conclusion of our presentation on two-legged option strategies, and also upon the commentary of different events and trades that took place during the week. We shall continue with our discussion on four-legged option strategies in our next video. But before we go on to that stage, we would like to stress upon the importance of three different elements that must be understood very clearly and should be implemented on every option strategy trade that one gets into. These elements are, the first one being time decay. Time decay is a very important role in the life of an option trade. One needs to see if the time decay is assisting the trade or is it going against the trade. The second one is implied volatility, which again has to be either in favor of the trade or against the trade, and one needs to notice the changes while managing the trade. Then we have the third one, which is the most important one while entering the trade, and that is the selection of the strike price at which you enter the option trade. One should not be lured by the greed to sell an option at a very high premium, thinking that he or she could make good money if the option expires unwritten or unassigned. The important part here is that the deeper in the money the option is, the more is the risk of getting assigned if you sell in the option. So the seller of the option should always be covered either by a long position on the underlying or another option that could risk his losses, that could reduce his risk and losses when he gets assigned if the trade turns negative against him. We wish you all the very best for your next trading week, and you have a good weekend. If you've liked our channel, please give us a thumbs up and hit the button underneath to subscribe to our channel Polo Vega. You may also visit us at our website www.polovega.com or get in touch with us through our Twitter handle @PoloVega. We thank you for watching our video. Please like, share and subscribe to our channel Polo Vega.